of earnings, that is a loss in value of only about 15%, much of which has historically been offset by temporarily high post-recovery earnings. It is best to enter an active research race with the fewest competitors. If most investment analysts are looking to forecast change, then concentrating on stability will provide a greater chance of success. Having a differentiated view about the next 3 to 5 years is more likely to lead to outperformance than intense focus on the current quarter's sales growth rate. For all these reasons, a Graham and Dodd approach that incorporates the same contrarian stance toward research as it does toward finding undervalued stocks is likely to produce superior results. 10. Risk management and building portfolios. In the late 1970s, a major American corporation decided to evaluate its pension fund. The study began by reviewing the performance of the company's equity managers, of whom there were well over 100. The examination first looked at trading costs. To start, the analysts simply calculated how much the sales of one manager offset the buys of another during any given week. To the company's surprise, in a typical week, approximately 90% of orders netted out. With hundreds of managers, positive and negative sentiment on any particular stock tended to be evenly distributed. Selling by pessimists largely matched buying by optimists. Indeed, if the pension fund had not been steadily receiving more contributions to cover current employees than it was paying out to retirees, the percentage of offsetting trades would have been even higher. There was a similar issue with the net buys. The actions of hundreds of independent investment managers as a group assembled a portfolio that closely tracked the stock market. Managers who were attracted to a particular industry or stock, say a small oil company, were counterbalanced by other managers who felt just the opposite. As a result, more than 90% of net purchases simply mirrored the stock market as a whole. Overall, more than 99% of all trading activity involved buying the equivalent of passive index funds while paying for active management. The lesson here is not just that too many cooks spoil the broth. More carefully selected managers with designedly different perspectives might have reduced the extent of self-canceling investments. The real import is that for some purposes, decentralizing investment decisions cannot be done successfully. In the case of this large pension fund, requiring that orders be submitted to a central in-house clearing facility, and then only executing net orders achieved significant savings. Buying index funds and acting only on deviations from the market portfolio would have saved even more without ignoring the net decisions of the individual managers. An equivalent problem arises when risk management decisions for a large portfolio are made by a number of independent investment managers. Some managers will be embracing risks that other managers are avoiding. The portfolio as a whole may own costly hedges put in place by one manager, while another manager has intentionally chosen exposure to those same risks. Alternatively, if one manager is long a stock, while another manager is short a similar stock, then the portfolio may be hedged without incurring the cost of explicit risk mitigation transactions. Wealth owners who delegate investing to multiple individual managers must know what their aggregate portfolios look like before they can effectively assess and protect against their vulnerabilities. Efficient risk management requires that wealth owners hedge their aggregate vulnerabilities and not allow hedging to take place at the level of each individual manager. The first fundamental principle of risk management is that the ultimate wealth owners or their designees must manage risk centrally. Risk management must be customized as well as centralized. Investment management firms that attempt to handle risk with a single model for all their clients will do this job badly for several reasons. First, each wealth owner is likely to have allocated funds to a different set of investment managers. The relationship between one investment manager's portfolio and the portfolio of each of the client's other managers will vary from client to client. What may represent valuable risk management for one client may represent unnecessary diversification for another. This problem is exacerbated because many wealth owners, both individuals and institutions, have large and essentially illiquid holdings that constitute a major portion of their overall assets. Families with enough assets to require this level of professional help have likely earned their wealth from focused entrepreneurial ventures that continue to represent a major part of their holdings even after they have surrendered control. Other families have been successful in service businesses or real estate in particular geographies and continue to have major illiquid holdings in these places. Institutions such as universities or hospitals have core activities whose economic health often depends critically on local, national, or industry economic conditions. Individual investors have jobs that generate a major fraction of their wealth, and these jobs generally have exposure to particular industry and geographic risks. Proper risk management must take these commitments into account in building liquid investment portfolios. Investment managers usually don't have the knowledge, the expertise, or the time to do this for each individual client. An effective risk manager must be able to adjust to the needs of different wealth owners. A second critical aspect of centralized risk management is that it is better done separately from investment management. Wealth owners are the parties most familiar with their own overall holdings, commitments, and attitudes toward risk. They should therefore be the ones directing risk management activity. Given that most wealth owners are not qualified to handle this task well, they need professional risk managers to monitor the risks of the subordinate investment managers and manage overall risk for each client separately. This imperative is increasingly well recognized in the wealth management business. Individual or shared family offices often apportion assets among investment managers, but manage overall risks for each client. Large institutions have portfolio management offices that perform the same functions. Smaller institutions are beginning to get into the equivalent of multi-family offices. However, individual investment managers have not fully adapted to this reality. Too many of them deal with risk as if they were managing all of each client's wealth. As a result, they are often insufficiently specialized and hold portfolios that are far too broadly diversified when part of a large pool of assets. In what follows, we will talk about risk management while clearly delineating the distinct roles of wealth and investment managers. Defining appropriate measures of risk. The first step in describing an effective risk management process is to define properly the risk that must be managed. Currently, the most commonly used risk metric is portfolio volatility, measured by the variance of the value of the wealth owner's total holdings. In theory, this overall portfolio should include the illiquid assets of the sort we described before. In practice, variances are usually calculated and managed only for the security portfolios of wealth holders, because assessing variances for the values of illiquid holdings is hard to do. Beyond this exclusion, there are other serious problems with using security portfolio variances as measures of wealth holder risk. First, the range of possible wealth levels becomes wider as we move further into the future. Likely changes in the value of holdings between today and the end of next week should be small. Likely changes between now and the end of next year will be larger. Likely changes between today and 10 years from today will be much larger still. Thus, when we look at wealth variances, and by this we mean future wealth variances, we must specify the length of time over which we are considering future changes, which is our investment horizon. Common practice identifies only a single variance without specifying the period to which it applies. The reason for this omission is an important assumption that underlies conventional variance measures, namely, that unanticipated, and hence uncertain future changes in value are unrelated between one period and the next. If tomorrow's value happens to increase, one assumes that this indicates nothing about what happens the day after tomorrow. In this case, the 2-day variance is just the sum of two independent one-day variances. If we further assume that the daily variances are all equal, then the 2-day variance is 2 times the daily variance. For a month of 21 trading days, the monthly variance will be thus 21 times the daily variance. The annual variance will be 12 times the monthly variance, or 252, 12 times 21 times the daily variance. Under this assumption, once a standard time period has been defined, usually a year for the purposes of calculating a standard variance, the variance of any other period can be calculated by simply multiplying the standard variance by the ratio of the length of the other period to a year. With this in mind, we can sensibly talk about the standard variance as the variance of a portfolio. Unfortunately, financial market reality does not reflect the independence assumption outlined before. In the short run, generally up to 6 months, daily changes in value tend to be positively correlated. If stock prices are up today, they are more likely to be up tomorrow. As a result, the 2-day variance is more than twice the size of the single-day variance. For periods of up to 6 months, longer period variances are generally proportionally greater than short period variances. Thus, the period to which a variance applies has to be specified and calculated separately. For periods longer than a year, changes in asset values tend to be negatively correlated. If this year was up, next year is more likely to be down. Thus, the 2-year variance, because of this offsetting change, will be smaller than the single-year variance. There is regression to the mean in the longer run. Again, variance cannot be specified without reference to the period over which it applies. If variance is a measure of risk, then an investor has to decide whether to be concerned with relatively short-run risk, say 1 year, or long-run risk. Graham and Dodd intuitively recognized this fact and explicitly focused on the long run, an approach that remains dominant among value investors. The second issue with variance as a measure of risk is that it fails to distinguish between upside and downside deviations from the average expected return. The assumption is that distribution of returns is symmetrical. With upside and downside variations equal, there is need for only a single variance measure. In reality, return distributions are not symmetrical. They have much greater upside than downside deviations. Positive returns are potentially unlimited, while negative returns are capped at minus 100%. Variance measures of risk are dominated, therefore, by upside uncertainty. Yet when most people think of risk, they usually see it as the possibility of losses, not outsized gains. Graham and Dodd were also well aware of this shortcoming. In assessing the risk of an investment, they recommended focusing solely on possibilities of loss. Together with their concentration on long-term returns, their preferred measure of risk was the likelihood and size of potential permanent loss. In their words, risk was the possibility of a permanent impairment of capital. Unfortunately, permanent impairment of capital is not as easily quantifiable as variance. However, it can still serve as a sound basis for formulating risk management strategies and ultimately quantifying the overall risk exposure of the complete holdings of any particular wealth owner. Because of the temporal differences in variance and its deviation from what most people understand as risk, we will use permanent loss as our definition of risk. Limiting permanent loss of capital. Permanent loss of capital typically arises from one of 3 sources. The first is paying too much for a security. The fastest way permanently to lose 50% of your capital is to pay $100 for a security worth only $50. The moment of purchase is the time of maximum risk, if by risk you mean a permanent loss. Protection against overpaying begins with a sensible search strategy. Purchases of overpriced securities occur most often when markets are experiencing extreme overvaluation, which after the fact are called bubbles. They are characterized by outsized ratios of market prices to underlying measures of economic value, such as price to sustainable earnings ratios above 30 or price to book ratios of 8 or more for typical stocks. These valuations invariably appear as a consequence of rising securities prices over an extended period. This was the case of Japanese stocks in the late 1980s, tech, internet, and telecom stocks in the late 1990s, and housing and associated financing institutions in the run-up to the financial crisis of 2008. Avoiding these situations ought to be an essential characteristic of a well-conceived search strategy. If there is any significant probability that a group of securities are in bubble territory, those stocks should not be purchased. At best, they will fall into the too tough to call category. Sooner or later, there are always more attractive alternative opportunities. More generally, value-based protection against permanent loss of capital at purchase depends on a margin of safety between the price paid and the estimated value of an investment. For a disciplined Graham and Dodd investor, an adequate margin of safety is the most important measure of investment safety. This approach requires a valuation process that produces an accurate assessment of intrinsic worth, whether a discounted cash flow for near-term fixed return opportunities, an asset value or earnings power value for non-franchise businesses, or assets and cash plus prospective growth returns for franchise businesses. For some companies, notably new, rapidly growing franchise businesses, it may be impossible to arrive at a sufficiently accurate valuation on which to base an investment. These companies, however attractive they appear, should be filed away in the too tough to call category, and for risk management reasons, only purchased when more accurate estimates are possible. A second source of permanent loss is excessive leverage. Levels of indebtedness at the company level that lead to bankruptcy, or even extended impairment of the company's competitive position, will convert temporary losses into permanent ones. Ideally, debt at the company level should be low enough so that even in reasonable worst-case situations, say 3 consecutive bad years, operating earnings and capital recoveries are adequate not only to cover any debt service requirements, but also to avoid any doubts about future solvency that might materially impair the firm's standing with customers, suppliers, employees, regulators, or necessary sources of future funding. At the investment portfolio level, margin debt that leads to forced sales in the face of short-term market declines will also convert temporary losses into permanent ones. Leverage of this sort should also be avoided. Investing in time-limited options that enhance upside returns is a kind of leverage that is equally risky. If a temporary downturn persists past the date of option expiration, then the options will expire worthless and the loss will become permanent. The second principle of permanent loss-focused risk management is to avoid excessive leverage, which can be lethal. If you are uncertain when leverage becomes excessive, it is wise to avoid it altogether. Diversification. If securities are bought with an adequate margin of safety and excessive leverage is avoided, then permanent losses will generally arise for only 2 reasons. The first is overestimation of the security's intrinsic worth at the time of purchase, a simple mistake in valuation. The second is a major unanticipated adverse development affecting the financial position of the issuing company. For careful, disciplined investors, both these events should be essentially random occurrences. For an investor who carefully monitors his or her past performance and learns to avoid repeated systematic errors, such as persistent optimism with respect to value-creating business growth, or sustainable earnings valuations that fail to incorporate the possibility of recession years, Overvaluations will only occur in the face of new developments that are not sufficiently anticipated. By their very nature, these mistakes should be unsystematic. Unanticipated events that permanently impair a company's position will generally be either company or industry specific. At the company level, its new product initiative or geographic expansion turns out to be a disastrous failure. A new competitor makes unexpected inroads enabled by a company management's current inattention, or a new management focuses on ill-advised expansion at the expense of operating efficiency. At the industry level, such events should be specific to particular types of businesses and geographic areas. These might include new technologies that undermine an industry's current economic position or the value of its assets, government regulatory changes that whittle down industry profitability, the adverse impact of globalization on markets, or the collapse of cooperative industry norms under the weight of new competitors. Developments like these will rarely have economy-wide implications. Another kind of idiosyncratic risk arises in the area of event-driven investing. Arbitrage positions, investments in companies being taken over or in newly spun-off divisions, investments in securities of companies in Chapter 11, investments in companies in the process of liquidation, are all investments where the size of the payoff may be well defined, but the timing is uncertain. It is usually independent of the timing of other such events and the general economic conditions that determine the returns of other securities. The arrival of a payoff is an unsystematic event causing unsystematic risk. Unsystematic risks of this sort can generally be diversified away. Consider the case of a small oil company that drills a single well with a 20% chance of success. For an investor in only that company, a dry hole, which occurs 80% of the time, represents a total permanent loss of capital. The small oil company investment appears to be extremely risky. Now suppose there are 1,000 other small oil companies with similar prospects for drilling in different areas, whose 20% probabilities of striking oil are completely unrelated to each other. Overall, 200 will be successful. The likely range of successful wells run from 150 to 250. If an investor spreads his or her investment over the entire 1,000 wells, placing 0.1% of the total in each one, the maximum loss is not a 100% loss, 80% of the time, but a 25% loss, 50 divided by 200, that occurs only about 5% of the time. In fact, the situation is better than this. If a successful well returns 5.5 times its cost, which is necessary to provide a reasonable 10% average return, then the 150 worst-case successful wells will produce a return of 825 times the amount invested, or a loss of only 17.5%. 1,000 minus 825 divided by 1,000, which again occurs only about 5% of the time. Diversification reduces the potential loss from 100% in 80% of the instances to 17.5%, less than 5% of the time. Risk in the diversified portfolio of small oil companies does not disappear entirely, but it is greatly reduced. The expected maximum loss falls by more than 98%. The industry-wide risk of a decline in oil prices that affects all the small oil companies, and large ones as well, is not reduced by diversifying among them. However, diversification across industries will reduce even this risk. If our model investor has roughly equal holdings across 15 industries, only one of which is heavily dependent on oil prices, the oil companies themselves, then only about 7%, 1 divided by 15, of the effect of the lower oil prices, will appear as a reduction in the value of the overall portfolio. More realistically, although some industries will suffer from the decline in oil prices, those for whom petroleum is an input are likely to benefit more than enough to offset those direct losses, so that the overall exposure is likely to be below 7%. In both these cases, diversification reduces the worst-case permanent losses by 90% or more. This means that the risks of idiosyncratic errors and unanticipated developments can be largely eliminated by holding a properly diversified portfolio. Much of this risk reduction can be achieved by holding as few as 30 securities, appropriately diversified across industries and geographies. Complete diversification, holding a portfolio in which all securities are proportionately represented, is not necessary. A value investor can be adequately diversified while still holding a relatively concentrated portfolio of bargains. However, since permanent impairment of capital tends to arise from idiosyncratic events at the company and industry levels, a sensible level of diversification, i.e., 30 or more stocks from a range of industries and geographies, is even more important from a permanent loss perspective than it is for a variance-based measure of risk. In his writings and practice at Graham-Newman, Benjamin Graham explicitly endorsed the importance of diversification. For a diversified portfolio of stocks purchased with an adequate margin of safety and using appropriately low levels of leverage, the remaining risks are those that affect economies and financial markets as a whole. Permanent impairment of capital at this level typically is due to either markets at unsustainable price levels, Japan in the late 1980s, or national economies in terminal meltdown, Venezuela in the middle 2000s. As the recovery of securities markets in the wake of the 2008 to 2010 global economic crisis has shown, economies in well-functioning national environments are extraordinarily resilient. This may be due in part to government commitments to do whatever is required to sustain macroeconomic stability. There were wide variations in the degree and nature of government responses to the 2008-2010 crisis, and yet financial markets, with few exceptions, have recovered. This experience suggests that for the long run, comprehensive economic and financial impairment will be rare. Despite this sanguine view, there will always be areas and assets at risk of permanent damage. Unanticipated inflation of any size and duration is rarely, if ever, followed by equivalent price declines. Under these circumstances, fixed income assets with long maturities suffer significant and permanent losses, as institutions that relied on long-term bond income in the late 1950s found to their enduring cost. Equity markets can also experience more than decade-long periods of falling or flat valuations. Although the resilience of the underlying economies and businesses has usually ensured an adequate long-run return, low interim results can inflict serious pain on investors. It is prudent, therefore, to secure some protection against long-lived but less than permanent macroeconomic impairment. Global portfolio diversification should provide protection against the possibility of national economic difficulties. All investors, especially those in relatively unstable emerging societies, need some degree of global diversification. But as the 2008 crisis demonstrated, global markets are increasingly integrated, and national market returns have become more highly correlated. This convergence has meant that even global diversification will not provide complete protection against national macroeconomic dislocations. Managing global macroeconomic risks. For a disciplined value investor who is well diversified and selects individual investments with an adequate margin of safety, management of macroeconomic risks will generally be a matter of significant but secondary importance. This position is in stark contrast to the practice of adherents of modern portfolio theory, for whom managing macroeconomic risk is a primary concern. This MPT approach involves detailed attention to allocations among narrowly defined asset classes and to portfolios selected to have tailored exposures too intricately, and usually statistically defined macro risk factors, so-called factor investing. Most value investors think of macroeconomic risk as falling into one of two categories. First are inflationary environments, periods of relative prosperity for business but with high and unpredictable price inflation. Second are deflationary periods, in which prices are stable or even falling, but overall business conditions and growth rates are depressed. Inflation and deflation can actually coexist. Stagflation, weak growth, and high inflation characterized many developed economies in the 1970s and 1980s. Still, it is more useful to think of managing these two risks separately. Asset classes can be organized into four broad categories. First, there are assets with fixed nominal returns, bonds, notes, insurance policies, and other long-lived debt instruments, both public and private. These tend to do well in deflationary environments and poorly in inflationary ones. Second, there are real assets, natural resources, real estate, and non-franchise business. These do well in inflationary environments where their values over the long run rise with price levels and their returns are enhanced by prosperity. They tend to do poorly during deflationary periods. Third, there are franchise businesses, such as Coca-Cola, with pricing power and protection from the effects of intensified competition that typically comes with deflationary environments. They tend to be relatively immune to the adverse effects of both inflation and deflation. And finally, there are low-risk and very low-return alternatives such as cash and cash equivalents. For a value investor, bottom-up analysis will determine the investment choices within these three non-cash categories. If fixed income assets are cheap, by which we mean bonds with high yields when interest rates are likely to decline, then a portfolio will contain more of them. The same applies to real and franchise assets. This process by itself provides some degree of overall protection against macroeconomic risks, as investments are concentrated in cheaper, presumably less vulnerable asset classes. But a portfolio will inevitably be subject to residual macro risks, unless by chance it is composed entirely of franchise businesses. A portfolio dominated by fixed income holdings will require protection against inflation. A portfolio heavily weighted toward real assets will require insurance against deflation. It is only these residual portfolio level risks that should be insured against, and the insurance has to be managed centrally. There are three basic types of insurance. The first is to hold assets such as cash or gold that will maintain or increase their value as other asset prices fall. Often this allocation occurs naturally. If the search and valuation process reveals a scarcity of opportunities in all three non-cash asset classes, then by default, cash holdings will be high, and an investor may choose to hold some fraction of them in an asset such as gold. Gold prices have historically had a negative correlation with broader financial market prices and have provided long-term protection against inflation. The second form of insurance is selective short sales. This is the risk mitigation tactic that hedge funds attempt to supply on a decentralized basis. If done well, it provides useful insurance. However, there are three disadvantages to short sales. First, for taxable investors, short sale gains tend to get taxed as ordinary income, while long-term gains are generally taxed at preferential capital gains rates. This asymmetry makes short sales relatively expensive. Second, if the proceeds of short sales are held in cash, the average return on cash is typically well below the average returns on the shorted asset classes. For equities, the difference is usually somewhere between 4 and 8%. Therefore, short sales involve a significant average cost most of the time. Third, short sales have unfortunate risk characteristics in themselves. If a short goes wrong, the prices of the underlying security rises, and so too does the size of the short position. Larger positions mean greater risks to the portfolio. For short positions, miscalculations compound into significantly greater risks. On the losing side, in contrast, miscalculations lead to lower prices, shrinking positions, and less risk. To adjust for this asymmetry, investors who hedge with short positions tend to hold many more of them than they do long ones, but this means that each position is less well analyzed, which also has the unfortunate effect of increasing risk. The third insurance tactic is to use options. One way to employ them is to sell securities and purchase call options, which preserve upside returns and limit losses to the cost of the options. Another approach is to buy put options that enable an investor to sell securities at a set price, no matter how low the market price goes. But because options are time-limited, in order to provide continuous protection, an investor has to roll over a sequence of future dated options so that the options do not all expire at the same time. If they were to expire simultaneously, the degree of protection would fall to zero as that date approached. Also, options can be expensive, and the tax treatment of put options is usually the same as for short sales. However, there is a special advantage to option strategies if done well. Options are cheapest when markets are least volatile, which is when investors are most optimistic about the absence of disruptive future events. Historically, this level of confidence leads to high asset prices and greater risk. As a consequence, option strategies are most valuable when they are cheapest. Carefully implemented option strategies means buying options protection when the conventional wisdom is that they are unnecessary. For a disciplined value investor concerned with aggregate portfolio risk, this is probably the best form of insurance. But the insurance should cover only the long-term net vulnerability of the portfolio as a whole. Insuring cash or stable franchise businesses would be an unnecessary expense. Insuring fixed income and real asset portfolios separately rather than overall net exposures to inflationary and deflationary environments is equally inefficient. Behavioral risks. What we have discussed so far are risks that arise from the uncertainties of financial markets and the businesses whose unpredictable activities underlie the values of the securities involved. Another source of risk is the behavior of investors themselves, which is just as important as economic risks. For value managers, a danger arises when there are virtually no securities being sold at prices that offer adequate margins of safety. In these times, the manager is either selling without reinvesting the proceeds, or, if still reasonably satisfied with the existing portfolio, doing nothing at all. But watching cash accumulate or doing nothing does not satisfy the urge for action that motivates most hard-working investment managers. The natural temptation is to force the issue and buy something, which under these conditions is generally a mistake. The way to deal with this temptation, like most temptations, is to develop a plan in advance and then to stick to that plan, especially when the temptation to abandon it is strong. When there are no identifiable attractive buying opportunities, a value investor is ironically in a position similar to that which all investors are assumed to face under the efficient market hypothesis. Knowing nothing worth doing is close to knowing nothing advantageous at all, which is the unmistakable implication of the EMH. Thus, following the prescriptions of academic finance theory, the best course is a mix of a broadly diversified portfolio and a risk-free asset. The specific mix depends on the degree of risk aversion of the investor in question. For value investors who place a low value on market returns under these circumstances, the allocation will be heavily weighted toward cash. The most risk-averse value investors will hold all the cash. On the other hand, equity fund managers who are judged against a market index, such as the S&P 500, will minimize their career risk with an all S&P 500 portfolio. There is an issue of how best to define a broad market portfolio. Both history and insights from behavioral finance suggest that in markets with few, if any, value opportunities, a statistical portfolio of cheap stocks, low market to book, low price to earnings, or low by other valuation measures, will still outperform a market portfolio. Also, stock portfolios that weight component stock holdings equally have historically performed better than portfolios, such as the S&P 500, that weight stock holdings according to their market capitalizations. In low opportunity environments, then, a value investor might want to identify an equal-weighted portfolio with less invested in mega market capitalization stocks as the broad portfolio option in a cash portfolio mix. It is still important to remember that nothing works all the time, and if the manager is evaluated relative to the cap-weighted S&P 500, that is the safest place to hide until genuine opportunities appear. It is important to have thought ahead of time about the appropriate cash portfolio mix and the right security portfolio so that this default strategy can be automatically executed in a no-opportunity environment. The alternative is to search energetically for opportunities that are not there, relax margin of safety standards, and make poor individual investment decisions. The temptation to do something is powerful. Warren Buffett's notion that investing is a game with no called strikes, so that you can always wait for a fat pitch, is only part of the story. The problem is that in a world where manager performance is judged against average investor returns, which necessarily equal average asset returns, they run up the score whether you swing or not. A good default strategy is essential to being comfortable with this reality and acting rationally in this world. For non-professional investors, the costs of bad behavior have historically been severe. In periods where market returns have been between 7 and 11%, average individual investor returns are typically 1 to 5%, a difference of 600 basis points. In addition, the average money-weighted returns for investment funds have typically trailed the time-weighted returns by the same 600 basis points. In the first case, individual investors are getting into securities when prices are high and out of them when prices are low, exactly the wrong times. In the second case, investors are doing the same thing for individual investment funds, getting in and out at the wrong times. To put these losses in perspective, a truly outstanding investor will typically outperform the market over long periods by 3 to 5% per year. This is measurably less than the 6% loss attributable to the herd-like behavior of individual investors. On a positive note, someone has to be on the wrong side of that trade. The chances that multitudes of individuals will modify their behavior and stop buying high and selling low are slim. If the behavioral psychologists and their economic associates are right, these kinds of reactions are hardwired in our brains, the result of evolution over many generations. But for at least some investment managers, there is hope. They can either try to select investors who don't behave this way, an option more available to hedge funds and other investment partnerships than to typical mutual funds, or they can try to educate their clients about the folly of chasing performance. The extent to which investment advisors can persuade their clients to stay the course in good times and bad will have a greater beneficial impact on long-term investor returns than all but the very best investment decision-making. A simple rebalancing of portfolios is one way to accomplish this goal. When a particular class of investments does well relative to other classes, it will represent a larger share of the overall portfolio value. Trimming under these conditions to return to the preset asset mix while adding to those classes that have lagged counteracts the natural tendency to buy when prices are high and rising and sell when they are low and falling. Systematic rebalancing has in practice significantly enhanced portfolio returns. It is a valuable tool for managing behavioral risk. Structures for risk management. The optimal structure for risk management is different from the optimal structure for security selection. Security selection can be decentralized, and because specialization improves investment choices, benefits from decentralization. Risk management, as we pointed out at the beginning of this chapter, must be centralized. It is possible that the two functions may reside in the same organization, so that specialized industry and geography-focused analysts recommend position sizes based on their levels of conviction, and portfolio managers have control over the overall portfolio and are therefore responsible for risk management. Such a structure makes sense when, as in the case of the Baupost Group, an organization is fully informed about all of its clients' holdings. When wealth owners parcel out their assets among a number of independent asset managers, there must be some central authority that is responsible for overall portfolio structure and risk management. Sophisticated wealth owners, with the time necessary to supervise their holdings, may perform this centralized risk management task themselves, but more often, wealth owners will lack the capacity, the time, or the inclination. Thus, the recent evolution of wealth management has been in the direction of dedicated family offices, sometimes with a multifamily client base, and institutional asset management groups. These offices parcel out funds to investment managers who will presumably invest shared pools of funds differently from one another. The investment managers must communicate the level of risk they are taking on and the broad nature of their investments so that wealth managers can control risks by 1. Properly allocating funds among investment managers, 2. Specifying position limits for these managers, e.g., if a client wealth owner has a major illiquid interest in the family automotive business, portfolio investments in autos should be strictly limited, and 3. Selectively hedging the risks of the aggregate portfolio, including the value of any ongoing business operations of the wealth-owning institution or family. As supervisory offices increasingly become responsible for portfolio construction and diversification, individual investment managers are likely to become more specialized and concentrated in a smaller number of securities. Having a portfolio of 30 or more stocks diversified across regions and industries may make sense for a total portfolio. But if the wealth manager has funds with 10 or more such managers, that overall diversification will involve either substantial redundancy or diversification over roughly 300 stocks, an unnecessarily large degree of diversification in most instances. Allocating funds into only specialized regional or industry managers eliminates this redundancy. But having 10 such managers, each with 3 specialties, holding 3 to 5 positions in each specialty, will lead to a portfolio of more than 100 stocks. Thus, the portfolios at the bottom of the pyramid, each run by a specialized manager, may have to consist of only 5 to 7 major positions. This degree of concentration will inevitably create problems for the primary investment managers, meaning the stock pickers. Concentrated portfolios will have relatively high levels of unsystematic risk that, while not diversified for the investment managers, is diversified away for the client wealth owners. Specialized managers, even those with as many as 5 specialties, may face extended periods where there are no attractive value investments in their target areas. Under these circumstances, investment managers should ideally communicate the lack of opportunity to clients. But this candor will be difficult if the investment manager must thereby put itself out of business for extended periods. Contracts between investment and risk managers will have to be designed in ways that protect investment managers without significantly reducing incentives to invest well. This will not be easy. Despite prior agreement on the specific roles of investors and risk managers, the urge to ask, "What have you done for me lately?" will be difficult to contain. Investor profiles. In the first edition of this book, we thought that it would be helpful to look beyond the basic principles of value investing and to describe in some detail what accomplished value investors actually do when they are at work. Benjamin Graham wrote 2 books, Security Analysis with David Dodd and The Intelligent Investor, that laid out his theory of investing and described his own practices. Investing was his primary profession. He taught as an adjunct, even though his course was famous and virtually mandatory for all serious Wall Street professionals. While we had some investment experience, it did not come close to Graham's level of practical knowledge. To compensate, we included a number of investor profiles in the first edition of this book. The chapters described how successful value-oriented investors did their jobs, and it included real examples from their experience. In alphabetical order, the investors included Warren Buffett, Mario Gabelli, Glenn Greenberg, Robert Heilbrunner, Seth Klarman, Michael Price, Walter and Edwin Schloss, and Paul Sonkin. The profiles were based on interviews, presentations made to classes in the value investing course at Columbia Business School, CBS, and extensive written records. Our investors ranged in age from 35 to over 90. 3 had worked for or with Graham himself. 2 others had worked for Max Hine, another legend in the field who first met Graham as his broker and maintained a close relationship with him. The remaining 3 attended Columbia Business School, where they took courses with Graham's successors Roger Murray and Bruce Greenwald. These investors practiced a broad range of value investing styles. Some concentrated on superior businesses purchased at reasonable prices. They intended to hold these firms for decades, if not longer. Others looked for damaged companies and assets offered for sale at distressed prices. Some ran portfolios with 6 or 8 stocks. Others owned hundreds of assorted investments at a time. Some of them thought the bonds of companies headed for or actually in bankruptcy, calculating that the bonds would earn them an attractive return either in cash, new debt, or equity in a post-bankruptcy reorganized company. Others sought to buy the shares of stable companies that they felt would command a premium above the public market price from a strategic investor purchasing the whole firm. Some sought to avoid the crowd by concentrating on small, obscure companies overlooked by investors with large amounts of capital to deploy. Others, who themselves had charge of mountains of investment funds, concentrated on large, well-established firms. Some of our investors bought only marketable securities. Others purchased entire companies or real estate. All the profiled investors specialized in one or some combination of these alternatives. Their approaches covered a full spectrum of investment possibilities. In the nearly 20 years since the first edition was written, some of the original investors no longer actively manage portfolios. We have included the profiles of Walter and Edwin Schloss and Robert Heilbrunner virtually unchanged. Walter Schloss, one of the most decent people in a sometimes nasty business, died in 2012. Warren Buffett has been very active and has produced 20 new annual reports with a wealth of investing wisdom. We have rewritten his profile to incorporate these insights. As before, we have relied almost entirely on Buffett's own writing, which is as skillful as his investing. In the case of the remaining investors, we have taken advantage of improvements in technology. Mario Gabelli, Glenn Greenberg, Seth Klarman, and Michael Price have all spoken to the Value Investing course as CBS almost every year for the last 20 years. These talks have been recorded and edited versions are available on the web. The necessary information to access them is at the end of this chapter. To supplement the videos, we have incorporated the narratives from the first edition for these investors in a single chapter and made that chapter also available online. We refer interested listeners to both the videos and the web versions of the first edition profiles. Since the first edition of this book appeared in 2001, value investors have faced major challenges. When we began writing in 1999, value investors were assumed to be a dying, if not dead, breed. By the time the book hit the stands in June 2001, the dot-com bubble had crashed, and value investors benefited from both their actual returns and the relative gap between them and the major indices, which took a dive when sock puppets hit the ground. But for the last 10 years, since the recovery from the Great Recession, value portfolios made up of stocks trading at lower than average P/E or market-to-book ratios have produced returns that trail both broad market indices and portfolios of growth stocks. In these unprecedented circumstances, many previously successful value investors have performed poorly. Several economic factors appear to be responsible. First, as economic activity has migrated from manufacturing to services, standard accounting measures have become less relevant as indicators of intrinsic value. To a large extent, the assets of service businesses are intangibles: product portfolios, brand images, customer relationships, trained workers, and organized capital, which are treated as current expenses and do not appear on traditional balance sheets. To get a useful estimate of a firm's intrinsic value based on its assets, value investors need to find creative but realistic ways of measuring and incorporating the value of intangible assets. At the same time, both investments in and depreciation of intangible assets are not well identified in traditional income statements. Expenditures on sales activity, advertising, training, and especially research and development that may have a substantial investment component, meaning that they generate revenue and income beyond the current year, are generally treated as current costs. The accounting treatment of depreciation and amortization typically does a poor job of measuring the true depreciation of intangible assets, if it measures it at all. Again, successful value investors must learn to adjust their earnings measures to account for these factors. The increasing importance of service businesses has a second consequence for investors, whether value-oriented or not. Services are generally locally produced and consumed. Service markets tend to be small and local rather than large and global. Small local markets, by contrast with large and global ones, are more easily dominated by single firms who enjoy economies of scale advantages. At the same time, service businesses involve more frequent and more important face-to-face contacts with customers than do firms that produce goods. Customer captivity grows out of these interactions. For both reasons, barriers to entry, what Warren Buffett and others refer to as moats, are likely to play a larger part in services than in manufacturing. The ability to value franchise businesses, including the value of growth, has become more important as services constitute a larger fraction of economic activity. To succeed, value investors must adjust their intrinsic value estimates to take this new reality into account. As information technology moves toward the cloud, hardware costs decline and software becomes more important. This move reinforces the consequences of the trend toward services. Artificial intelligence tends to be highly specialized. Popular game-playing programs are game-specific. Chess, Jeopardy, and Go programs, not general game-playing programs. In medicine, AI programs are specific to a medical specialty and disease. The cost structure of software products invariably means high fixed and low marginal costs, a structure that generates significant economies of scale. Specialized markets in product space, like geographically local markets in services, are more easily dominated than more general markets for microchips and other computer hardware. More than hardware, software use entails more continuous, direct customer interaction, which is a pathway to customer captivity. So technology, like services, tends to increase the importance of franchises, making growth a more important part of intrinsic value. Global investing has been an important consequence of the larger globalization trend of the last several decades. Successful value investors must now deal with global opportunity sets. The number and complexity of financial instruments available to investors has increased exponentially, presenting another challenge to value investors. The striking success of Warren Buffett and other value investors, including those we have profiled, attracted growing numbers of investors to the Graham-Dodd-Buffett camp. This trend was accelerated by comprehensive statistical studies that clearly demonstrated the superiority of a value approach to investing. Today, there are far more value investors with instantaneous access to comprehensive accounting and business information on the Internet, assessing value opportunities, than there were in 2000, in the wake of the tech and telecom mania. More skilled investors make it more difficult to achieve superior returns. To address these developments, we have expanded our set of profiles of successful value practitioners. We have added Thomas Rousseau, who specializes in global consumer product companies, especially those that are family-run. Andrew Weiss, who focuses on complex financial instruments, often with intricate administrative requirement. Paul Hilal, a serial specialist who undertakes active interventions to push management to improve the operations of a small number of companies. And Jan Hummel, who invests in small-cap businesses with dominant service components restricted to Germany, the Nordic countries, and the UK. We have provided brief introductory profiles for each. Edited videos for all of them are available online. Warren Buffett. Investing is allocating capital. Few will dispute the claim that Warren Buffett is the most illustrious investor ever. The recognition he has earned rests both on the exceptional returns he has provided for his partners and shareholders over more than 6 decades, and on his singular ability to explain the intricacies of his craft in a manner as long on clarity, modesty, and humor as it is short on pretense or self-exaltation. In the years he ran his limited partnerships, from 1956 through 1969, and beginning again in 1977 as chairman of Berkshire Hathaway, Buffett has written annual letters that report the major choices he has made during the year, and of more permanent significance, the investment philosophy that has guided his actions. To say that these letters are a rich source of investment wisdom is to understate their true worth, as all the authors who collect royalties on books mined from this correspondence will attest. We have selected passages from the letters during the Berkshire Hathaway years and organized them to reveal what we consider the most significant elements of Buffett's approach to investing. The full text of these letters is available online and may be read and downloaded from the company's website. All the material is copyrighted by Warren Buffett, and it is quoted here with his permission. In addition to the selection and organization of these excerpts, we will confine our contribution to a few remarks about Buffett as an investor. First, as he himself says frequently in the letters, his association with his Berkshire partner, Charlie Munger, helped to move him away from an orthodox Benjamin Graham preference for buying assets at a deep discount to their value, no matter how miserable the company in which they were found, to buying good or excellent businesses at a reasonable price. While Buffett in the Berkshire years still speaks with reverence about Graham, he looks for companies that have strong franchises and outstanding management, even though they may sell for multiples of their book value. Second, while many investors say that they think of themselves as buying businesses rather than stocks or bonds, Buffett really means it. Berkshire Hathaway itself is a hybrid. It owns some businesses outright, including a number of insurance companies, and it has large investments in companies whose shares are still publicly traded. As Berkshire has increased in size, the number of market-based opportunities capable of absorbing significant amounts of its ocean of investable capital has diminished dramatically. As a result, Buffett has devoted an ever greater fraction of that capital to the acquisition and development of whole businesses. But this evolution has not required any readjustment of his basic investment philosophy. Carol Loomis, an observer and friend of Buffett for many years, wrote that the key point about the two Buffetts, the investor and the businessman, is that they look at the ownership of businesses in exactly the same way. The investor sees the chance to buy portions of a business in the stock market at a price below intrinsic value, that is, below what a rational buyer would pay to own the entire establishment. The manager sees the chance to buy the whole business at no more than intrinsic value. The kind of merchandise that Buffett wants is simple, described also good businesses. To him, that essentially means operations with strong franchises, above-average returns on equity, a relatively small need for capital investment, and the capacity, therefore, to throw off cash. That list may sound like motherhood and apple pie, but finding and buying such businesses isn't easy. Buffett likens the hunt to bagging rare and fast-moving elephants. Or, to say the same thing in somewhat different terms, no matter what is being bought, investing is allocating capital. Finally, value investors share the conviction that they are most successful when they stay within their circle of competence. Buffett speaks repeatedly of looking for businesses that he can understand, and his avoidance of companies whose fortunes depend on their technological excellence is well chronicled. Resting within the confines of businesses that he definitely does understand, which include insurance, media companies, and consumer goods firms, he has earned a lot of money for himself and for those who have invested with him over the years. It may seem odd to claim that the greatest investor ever has made fortunes by following the humble precept of sticking to his knitting, and surely his superiority stems from more than adhering to this rule. Still, the gallery of investors is replete with geniuses who stumbled when they wandered away from their zones of excellence. Just as Coca-Cola discovered it was better at making and selling soft drinks than in producing films, Buffett has had the sense to recognize the boundaries of his own franchise. General investment principles. It's been an easy matter for Berkshire and other owners of American equities to prosper over the years. Between December 31st, 1899, and December 31st, 1999, to give a really long-term example, the Dow rose from 66 to 11,497. This huge rise came about for a simple reason. Over the century, American businesses did extraordinarily well, and investors rode the wave of their prosperity. Businesses continue to do well. But now, shareholders, through a series of self-inflicted wounds, are in a major way cutting the returns they will realize from their investments. The explanation of how this is happening begins with a fundamental truth. With unimportant exceptions, such as bankruptcies in which some of a company's losses are borne by creditors, the most that owners in aggregate can earn between now and Judgment Day is what their businesses in aggregate earn. True, by buying and selling that is clever or lucky, Investor A may take more than his share of the pie at the expense of Investor B. And yes, all investors feel richer when stocks soar. But an owner can exit only by having someone take his place. If one investor sells high, another must buy high. For owners as a whole, there is simply no magic, no shower of money from outer space that will enable them to extract wealth from their companies beyond that created by the companies themselves. 2005. So that was my argument. And now let me put it into a simple equation. If Group A, active investors, and Group B, do-nothing investors, comprise the total investing universe, and B is destined to achieve average results before costs, so too must A. Whichever group has the lower costs will win. The academic in me requires me to mention that there is a very minor point, not worth detailing, that slightly modifies this formulation, and if Group A has exorbitant costs, its shortfall will be substantial. There are, of course, some skilled individuals who are highly likely to outperform the S&P over long stretches. In my lifetime, though, I've identified early on only 10 or so professionals that I expected would accomplish this feat. There are no doubt many hundreds of people, perhaps thousands, whom I have never met and whose abilities would equal those of the people I've identified. The job, after all, is not impossible. The problem simply is that the great majority of managers who attempt to overperform will fail. The probability is also very high that the person soliciting your funds will not be the exception who does well. Bill Ruan, a truly wonderful human being and a man whom I identified 60 years ago as almost certain to deliver superior investment returns over the long haul, said it well. In investment management, the progression is from the innovators to the imitators to the swarming incompetents. Further complicating the search for the rare, high-fee manager who is worth his or her pay is the fact that some investment professionals, just as some amateurs, will be lucky over short periods. If 1,000 managers make a market prediction at the beginning of a year, it's very likely that the calls of at least one will be correct for 9 consecutive years. Of course, 1,000 monkeys would be just as likely to produce a seemingly all-wise profit, but there would remain a difference. The lucky monkey would not find people standing in line to invest with him. Finally, there are 3 connected realities that cause investing success to breed failure. First, a good record quickly attracts a torrent of money. Second, huge sums invariably act as an anchor on investment performance. What is easy with millions struggles with billions. Sob. Third, most managers will nevertheless seek new money because of their personal equation, namely, the more funds they have under management, the more their fees. 2016. Objective of investment for Berkshire Hathaway. Our long-term economic goal, subject to some qualifications mentioned later, is to maximize Berkshire's average annual rate of gain in intrinsic business value on a per-share basis. We do not measure the economic significance or performance of Berkshire by its size. We measure by per-share progress. We are certain that the rate of per-share progress will diminish in the future. A greatly enlarged capital base will see to that. But we will be disappointed if our rate does not exceed that of the average large American corporation. From owner-related business principles, many years. Because Berkshire Hathaway is committed to issue new shares only when the intrinsic value received in exchange exceeds the value of the issued shares, and to repurchase shares only when they are available at prices below Berkshire's intrinsic value, maximizing the growth of intrinsic value per share is equivalent to maximizing Berkshire's intrinsic value. The definition and estimation of intrinsic value is at the heart of Buffett and Munger's investment philosophy. Performance measurement. From the start, Charlie and I have believed in having a rational and unbending standard for measuring what we have, or have not, accomplished. That keeps us from the temptation of seeing where the arrow of performance lands and then painting the bullseye around it. Selecting the S&P 500 as our bogey was an easy choice because our shareholders, at virtually no cost, can match its performance by holding an index fund. Why should they pay us for merely duplicating that result? 2009. Realistic return expectations. Let's revisit some data I mentioned 2 years ago. During the 20th century, the Dow advanced from 66 to 11,497. This gain, though it appears huge, shrinks to 5.3% when compounded annually. An investor who owned the Dow throughout the century would also have received generous dividends for much of the period, but only about 2% or so in the final years. It was a wonderful century. Think now about this century. For investors to merely match that 5.3% market value gain, the Dow, recently below 13,000, would need to close at about 2 million on December 31st, 2099. We are now 8 years into this century, and we have racked up less than 2,000 of the 1,988,000 Dow points the market needed to travel in this 100 years to equal the 5.3% of the last. Dividends continue to run about 2%. Even if stocks were to average the 5.3% annual appreciation of the 1900s, the equity portion of plan assets, allowing for expenses of 0.5%, would produce no more than 7% or so, and 0.5% may well understate costs given the presence of layers of consultants and high-priced managers, helpers. I should mention that people who expect to earn 10% annually from equities during this century, envisioning that 2% of that will come from dividends and 8% from price appreciation, are implicitly forecasting a level of about 24 million on the Dow by 2100. If your advisor talks to you about double-digit returns from equities, explain this math to him, not that it will faze him. Many helpers are apparently direct descendants of the Queen in Alice in Wonderland, who said, "Why, sometimes I've believed as many as 6 impossible things before breakfast." Beware the glib helper who fills your head with fantasies while he fills his pockets with fees. 2007. Measuring intrinsic value. Our equity investing strategy remains little changed from what it was 15 years ago, when we said in the 1977 annual report, we select our marketable equity securities in much the way we would evaluate a business for acquisition in its entirety. We want the business to be one, A, that we can understand, B, with favorable long-term prospects, C, operated by honest and competent people, and D, available at a very attractive price. We have seen cause to make only one change in this creed. Because of both market conditions and our size, we now substitute an attractive price for a very attractive price. But how, you will ask, does one decide what's attractive? In answering this question, most analysts feel they must choose between two approaches customarily thought to be in opposition: value and growth. Indeed, many investment professionals see any mixing of the two terms as a form of intellectual cross-dressing. We view that as fuzzy thinking, in which, it must be confessed, I myself engaged some years ago. In our opinion, the two approaches are joined at the hip. Growth is always a component in the calculation of value, constituting a variable whose importance can range from negligible to enormous, and whose impact can be negative as well as positive. In addition, we think the very term value investing is redundant. What is investing if it is not the act of seeking value at least sufficient to justify the amount paid? Consciously paying more for a stock than its calculated value in the hope that it can soon be sold for a still higher price should be labeled speculation, which is neither illegal, immoral, nor, in our view, financially fattening. Whether appropriate or not, the term value investing is widely used. Typically, it connotes the purchase of stocks having attributes such as a low ratio of price to book value, a low price-earnings ratio, or a high dividend yield. Unfortunately, such characteristics, even if they appear in combination, are far from determinative as to whether an investor is indeed buying something for what it is worth and is therefore truly operating on the principle of obtaining value in his investments. Correspondingly, opposite characteristics, a high ratio of price to book value, a high price to earnings ratio, and a low dividend yield, are in no way inconsistent with a value purchase. Similarly, business growth per se tells us little about value. It's true that growth often has a positive impact on value, sometimes one of spectacular proportions, but such an effect is far from certain. For example, investors have regularly poured money into the domestic airline business to finance profitless, or worse, growth. For these investors, it would have been far better if Orville had failed to get off the ground at Kitty Hawk. The more the industry has grown, the worse the disaster for owners. The growth benefits investors only when the business in point can invest at incremental returns that are enticing. In other words, only when each dollar used to finance the growth creates over $1 of long-term market value. In the case of a low-return business requiring incremental funds, growth hurts the investor. In The Theory of Investment Value, written over 50 years ago, John Burr Williams set forth the equation for value, which we condense here. The value of any stock, bond, or business today is determined by the cash inflows and outflows, discounted at an appropriate interest rate, that can be expected to occur during the remaining life of the asset. Note that the formula is the same for stocks as for bonds. Even so, there is an important and difficult to deal with difference between the two. A bond has a coupon and maturity date that define future cash flows, but in the case of equities, the investment analyst must himself estimate the future coupons. Furthermore, the quality of management affects the bond coupon only rarely, chiefly when management is so inept or dishonest that payment of interest is suspended. In contrast, the ability of management can dramatically affect the equity coupons. The investment shown by the discounted flows of cash calculation to be the cheapest is the one that the investor should purchase, irrespective of whether the business grows or doesn't, displays volatility or smoothness in its earnings, or carries a high price or low in relation to its current earnings and book value. Moreover, though the value equation has usually shown equities to be cheaper than bonds, that result is not inevitable. When bonds are calculated to be the more attractive investment, they should be bought. Leaving the question of price aside, the best business to own is one that over an extended period can employ large amounts of incremental capital at very high rates of return. The worst business to own is one that must or will do the opposite, that is, consistently employ ever greater amounts of capital at very low rates of return. Unfortunately, the first type of business is very hard to find. Most high-return businesses need relatively little capital. Shareholders of such a business usually will benefit if it pays out most of its earnings in dividends or makes significant stock repurchases. Though the mathematical calculations required to evaluate equities are not difficult, an analyst, even one who is experienced and intelligent, can easily go wrong in estimating future coupons. At Berkshire, we attempt to deal with this problem in two ways. First, we try to stick to businesses we believe we understand. That means they must be relatively simple and stable in character. If a business is complex or subject to constant change, we're not smart enough to predict future cash flows. Incidentally, that shortcoming doesn't bother us. What counts for most people in investing is not how much they know, but rather how realistically they define what they don't know. An investor needs to do very few things right, as long as he or she avoids big mistakes. Second, and equally important, we insist on a margin of safety in our purchase price. If we calculate the value of a common stock to be only slightly higher than its price, we're not interested in buying. We believe this margin of safety principle, so strongly emphasized by Ben Graham, to be the cornerstone of investment success. 1992. Increasing wealth is not the same as increasing size. When Charlie and I buy stocks, which we think of as small portions of businesses, our analysis is very similar to that which we use in buying entire businesses. We first have to decide whether we can sensibly estimate an earnings range for 5 years out or more. If the answer is yes, we will buy the stock or business if it sells at a reasonable price in relation to the bottom boundary of our estimate. If, however, we lack the ability to estimate future earnings, which is usually the case, we simply move on to other prospects. In the 54 years we have worked together, we have never foregone an attractive purchase because of the macro or political environment or the views of other people. In fact, these subjects never come up when we make decisions. It's vital, however, that we recognize the perimeter of our circle of competence and stay well inside of it. Even then, we will make some mistakes, both with stocks and businesses, but they will not be the disasters that occur, for example, when a long rising market induces purchases that are based on anticipated price behavior and a desire to be where the action is. 2013. Measuring Berkshire's intrinsic value. The first component of value is our investments, stocks, bonds, and cash equivalents. At year-end, these totaled $158 billion at market value. Insurance float, money we temporarily hold in our insurance operations that does not belong to us, funds $66 billion of our investments. This float is free as long as insurance underwriting breaks even, meaning that the premiums we receive equal the losses and expenses we incur. Of course, underwriting results are volatile, swinging erratically between profits and losses. Over our entire history, though, we've been significantly profitable, and I also expect us to average break-even results or better in the future. If we do that, all of our investments, those funded both by float and by retained earnings, can be viewed as an element of value for Berkshire shareholders. Berkshire's second component of value is earnings that come from sources other than investments and insurance underwriting. These earnings are delivered by our 68 non-insurance companies. In Berkshire's early years, we focused on the investment side. During the past 2 decades, however, we've increasingly emphasized the development of earnings from non-insurance businesses, a practice that will continue. For the 40 years, our compounded annual gain in pre-tax, non-insurance earnings per share is 21%. During the same period, Berkshire's stock price increased at a rate of 22.1% annually. Over time, you can expect our stock price to move in rough tandem with Berkshire's investments and earnings. Market price and intrinsic value often follow very different paths, sometimes for extended periods, but eventually they meet. There is a third, more subjective element to an intrinsic value calculation that can be either positive or negative: the efficacy with which retained earnings will be deployed in the future. We, as well as many other businesses, are likely to retain earnings over the next decade that will equal or even exceed the capital we presently employ. Some companies will turn these retained dollars into 50-cent pieces, others into $2 bills. This "what will they do with the money" factor must always be evaluated along with the "what do we have now" calculation in order for us or anybody to arrive at a sensible estimate of a company's intrinsic value. That's because an outside investor stands by helplessly as management reinvests his share of the company's earnings. If a CEO can be expected to do this job well, the reinvestment prospects add to the company's current value. If the CEO's talents or motives are suspect, today's value must be discounted. The difference in outcome can be huge. $1 of then value in the hands of Sears Roebuck's or Montgomery Ward's CEOs in the late 1960s had a far different destiny than did $1 entrusted to Sam Walton, 2010. A final word on measuring intrinsic value and investment versus speculation. Leaving aside tax factors, the formula we use for evaluating stocks and businesses is identical. Indeed, the formula for valuing all assets that are purchased for financial gain has been unchanged since it was first laid out by a very smart man in about 600 BC, though he wasn't smart enough to know it was 600 BC. The oracle was Aesop, and his enduring, though somewhat incomplete, investment insight was, "A bird in the hand is worth 2 in the bush." To flesh out this principle, you must answer only 3 questions. How certain are you that there are indeed birds in the bush? When will they emerge, and how many will there be? What is the risk-free interest rate, which we consider to be the yield on long-term U.S. bonds? If you can answer these 3 questions, you will know the maximum value of the bush, and the maximum number of the birds you now possess that should be offered for it. And of course, don't literally think birds. Think dollars. Aesop's investment axiom, thus expanded and converted into dollars, is immutable. It applies to outlays for farms, oil royalties, bonds, stocks, lottery tickets, and manufacturing plants. And neither the advent of the steam engine, the harnessing of electricity, nor the creation of the automobile changed the formula one iota. Nor will the internet. Just insert the correct numbers, and you can rank the attractiveness of all possible uses of capital throughout the universe. Common yardsticks such as dividend yield, the ratio of price to earnings or to book value, and even growth rates have nothing to do with valuation except to the extent they provide clues to the amount and timing of cash flows into and from the business. Indeed, growth can destroy value if it requires cash inputs in the early years of a project or enterprise that exceed the discounted value of the cash that those assets will generate in later years. Market commentators and investment managers who glibly refer to growth and value styles as contrasting approaches to investment are displaying their ignorance, not their sophistication. Growth is simply a component, usually a plus, sometimes a minus, in the value equation. Alas, though Aesop's proposition and the third variable, that is, interest rates, are simple, plugging in numbers for the other 2 variables is a difficult task. Using precise numbers is in fact foolish, Working with a range of possibilities is the better approach. Usually the range must be so wide that no useful conclusion can be reached. Occasionally, though, even very conservative estimates about the future emergence of birds reveal that the price quoted is startlingly low in relation to value. Let's call this phenomenon the IBT, inefficient bush theory. To be sure, an investor needs some general understanding of business economics, as well as the ability to think independently to reach a well-founded, positive conclusion. But the investor does not need brilliance nor blinding insights. At the other extreme, there are many times when the most brilliant of investors can't muster a conviction about the birds to emerge, not even when a very broad range of estimates is employed. This kind of uncertainty frequently occurs when new businesses and rapidly changing industries are under examination. In cases of this sort, any capital commitment must be labeled speculative. Now, speculation, in which the focus is not on what an asset will produce but rather on what the next fellow will pay for it, is neither illegal, immoral, nor un-American. But it is not a game in which Charlie and I wish to play. We bring nothing to the party, so why should we expect to take anything home? The line separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money. After a heady experience of that kind, normally sensible people drift into behavior akin to that of Cinderella at the ball. They know that overstaying the festivities, that is, continuing to speculate in companies that have gigantic valuations relative to the cash they are likely to generate in the future, will eventually bring on pumpkins and mice, but they nevertheless hate to miss a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There's a problem, though. They are dancing in a room in which the clocks have no hands. 2000. Risk management. Who's responsible? In my view, a board of directors of a huge financial institution is derelict if it does not insist that its CEO bear full responsibility for risk control. If he's incapable of handling that job, he should look for other employment. And if he fails at it, with the government thereupon required to step in with funds or guarantees, the financial consequences for him and his board should be severe. 2009. Diversification and concentration. Risk and return. The strategy we've adopted precludes our following standard diversification dogma. Many pundits would therefore say the strategy must be riskier than that employed by more conventional investors. We disagree. We believe that a policy of portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it. In stating this opinion, we define risk, using dictionary terms, as the possibility of loss or injury. Academics, however, like to define investment risk differently, averring that it is the relative volatility of a stock or portfolio of stocks, that is, their volatility as compared to that of a large universe of stocks. Employing databases and statistical skills, these academics compute with precision the beta of a stock, its relative volatility in the past, and then build arcane investment and capital allocation theories around this calculation. In their hunger for a single statistic to measure risk, however, they forget a fundamental principle: it is better to be approximately right than precisely wrong. For owners of a business, and that's the way we think of shareholders, the academic's definition of risk is far off the mark, so much so that it produces absurdities. For example, under beta-based theory, a stock that has dropped very sharply compared to the market, as had Washington Post when we bought it in 1973, becomes riskier at the lower price than it was at the higher price. Would that description have then made any sense to someone who was offered the entire company at a vastly reduced price? In fact, the true investor welcomes volatility. Ben Graham explained why in Chapter 8 of The Intelligent Investor. There he introduced Mr. Market, an obliging fellow who shows up every day to either buy from you or sell to you, whichever you wish. The more manic depressive this chap is, the greater the opportunities available to the investor. And that's true because a wildly fluctuating market means that irrationally low prices will periodically be attached to solid businesses. It is impossible to see how the availability of such prices can be thought of as increasing the hazards for an investor who is totally free to either ignore the market or exploit its folly. In assessing risk, a beta purist will disdain examining what a company produces, what its competitors are doing, or how much borrowed money the business employs. He may even prefer not to know the company's name. What he treasures is the price history of its stock. In contrast, we'll happily forgo knowing the price history and instead will seek whatever information will further our understanding of the company's business. After we buy a stock, consequently, we would not be disturbed if markets closed for a year or two. We don't need a daily quote on our 100% position in C's or H.H. Brown to validate our well-being. Why, then, should we need a quote on our 7% interest in Coke? In our opinion, the real risk that an investor must assess is whether his aggregate after-tax receipts from an investment, including those he receives on sale, will, over his prospective holding period, give him at least as much purchasing power as he had to begin with, plus a modest rate of interest on that initial stake. Though this risk cannot be calculated with engineering precision, it can in some cases be judged with a degree of accuracy that is useful. The primary factors bearing upon this evaluation are 1. The certainty with which the long-term economic characteristics of the business can be evaluated. 2. The certainty with which management can be evaluated, both as to its ability to realize the full potential of the business and to wisely employ its cash flows. 3. The certainty with which management can be counted on to channel the rewards from the business to the shareholders rather than to itself. 4. The purchase price of the business. 5. The levels of taxation and inflation that will be experienced and that will determine the degree by which an investor's purchasing power return is reduced from his gross return. These factors will probably strike many analysts as unbearably fuzzy, since they cannot be extracted from a database of any kind. But the difficulty of precisely quantifying these matters does not negate their importance, nor is it insuperable. Just as Justice Stewart found it impossible to formulate a test for obscenity, but nevertheless asserted, "I know it when I see it," so also can investors, in an inexact but useful way, see the risks inherent in certain investments without reference to complex equations or price histories. 1978. Good management from the Berkshire perspective. The most important factors determining a business's intrinsic value are the quality of management and the underlying economic quality of the business itself. Buffett has described at length what both good managements and good businesses look like. In 1983, I set down 13 owner-related business principles that I thought would help new shareholders understand our managerial approach. Although our form is corporate, our attitude is partnership. Charlie Munger and I think of our shareholders as owner partners and of ourselves as managing partners. Because of the size of our shareholdings, we are also, for better or worse, controlling partners. We do not view the company itself as the ultimate owner of our business assets, but instead view the company as a conduit through which our shareholders own the assets. In line with Berkshire's owner orientation, most of our directors have a significant portion of their net worth invested in the company. We eat our own cooking. Accounting consequences do not influence our operating or capital allocation decisions. When acquisition costs are similar, we much prefer to purchase $2 of earnings that is not reportable by us under standard accounting principles than to purchase $1 of earnings that is reportable. This is precisely the choice that often faces us, since entire businesses, whose earnings will be fully reportable, frequently sell for double the pro rata price of small portions, whose earnings will be largely unreportable. In aggregate and over time, we expect the unreported earnings to be fully reflected in our intrinsic business value through capital gains. We use debt sparingly. We will reject interesting opportunities rather than over-leverage our balance sheet. This conservatism has penalized our results, but it is the only behavior that leaves us comfortable, considering our fiduciary obligations to policyholders, lenders, and the many equity holders who have committed unusually large portions of their net worth to our care. As one of the Indianapolis 500 winners said, "To finish first, you must first finish." A managerial wish list will not be filled at shareholder expense. We will not diversify by purchasing entire businesses at control prices that ignore long-term economic consequences to our shareholders. We will only do with your money what we would do with our own, weighing fully the values you can obtain by diversifying your own portfolios through direct purchases in the stock market. We feel noble intentions should be checked periodically against results. We test the wisdom of retaining earnings by assessing whether retention, over time, delivers shareholders at least $1 of market value for each $1 retained. To date, this test has been met. We will continue to apply it on a 5-year rolling basis. As our net worth grows, it is more difficult to use retained earnings wisely. We will issue common stock only when we receive as much in business value as we give. This rule applies to all forms of issuance, not only mergers or public stock offerings, but stock for debt swaps, stock options, and convertible securities as well. We will not sell small portions of your company, and that is what the issuance of shares amounts to, on a basis inconsistent with the value of the entire enterprise. Owner's Manual, updated version. Every day, in countless ways, the competitive position of each of our businesses grows either weaker or stronger. If we are delighting customers, eliminating unnecessary costs, and improving our products and services, we gain strength. But if we treat customers with indifference or tolerate bloat, our businesses will wither. On a daily basis, the effects of our actions are imperceptible. Cumulatively, though, their consequences are enormous. When our long-term competitive position improves as a result of these almost unnoticeable actions, we describe the phenomenon as widening the moat. And doing that is essential if we are to have the kind of business we want a decade or two from now. We always, of course, hope to earn more money in the short term. But when short-term and long-term conflict, widening the moat must take precedence. If a management makes bad decisions in order to hit short-term earnings targets, and consequently gets behind the 8 ball in terms of costs, customer satisfaction, or brand strength, no amount of subsequent brilliance will overcome the damage that has been inflicted. Take a look at the dilemmas of managers in the auto and airline industries today as they struggle with the huge problems handed them by their predecessors. Charlie is fond of quoting Ben Franklin's, "An ounce of prevention is worth a pound of cure." But sometimes, no amount of cure will overcome the mistakes of the past. Our managers focus on moat widening and are brilliant at it. Quite simply, they are passionate about their businesses. Usually they were running those long before we came along. Our only function since has been to stay out of the way. If you see these heroes, and our 4 heroines as well, at the annual meeting, thank them for the job they do for you. It's hard to overemphasize the importance of who is CEO of a company. Before Jim Kiltz arrived at Gillette in 2001, the company was struggling, having particularly suffered from capital allocation blunders. In the major example, Gillette's acquisition of Duracell cost Gillette shareholders billions of dollars, a loss never made visible by conventional accounting. Quite simply, what Gillette received in business value in this acquisition was not equivalent to what it gave up. Amazingly, this most fundamental of yardsticks is almost always ignored by both managements and their investment bankers when acquisitions are under discussion. 2005. General acquisition behavior. As our history indicates, we are comfortable both with total ownership of businesses and with marketable securities representing small portions of businesses. We continually look for ways to employ large sums in each area. But we try to avoid small commitments. If something's not worth doing at all, it's not worth doing well. Indeed, the liquidity requirements of our insurance and trading stamp businesses mandate major investments in marketable securities. Our acquisition decisions will be aimed at maximizing real economic benefits, not at maximizing either managerial domain or reported numbers for accounting purposes. In the long run, managements stressing accounting appearance over economic substance usually achieve little of either. Regardless of the impact upon immediately reportable earnings, we would rather buy 10% of wonderful business T at X per share than 100% of T at 2 times per share. Most corporate managers prefer just the reverse and have no shortage of stated rationales for their behavior. However, we suspect 3 motivations, usually unspoken, to be singly or in combination the important ones in most high-premium takeovers. 1. Leaders, business or otherwise, seldom are deficient in animal spirits and often relish increased activity and challenge. At Berkshire, the corporate pulse never beats faster than when an acquisition is in prospect. 2. Most organizations, business or otherwise, measure themselves, are measured by others, and compensate their managers far more by the yardstick of size than by any other yardstick. Ask a Fortune 500 manager where his corporation stands on that famous list, and invariably, the number responded will be from the list ranked by size of sales. He may well not even know where his corporation places on the list Fortune just as faithfully compiles ranking the same 500 corporations by profitability. 3. Many managements apparently were overexposed in impressionable childhood years to the story in which the imprisoned handsome prince is released from a toad's body by a kiss from a beautiful princess. Consequently, they are certain their managerial kiss will do wonders for the profitability of Company T. Target. Such optimism is essential. Absent that rosy view, why else should the shareholders of Company A, acquisitor, want to own an interest in T at the 2 times takeover cost rather than at the X market price they would pay if they made direct purchases on their own? In other words, investors can always buy toads at the going price for toads. If investors instead bankroll princesses who wish to pay double for the right to kiss the toad, those kisses had better pack some real dynamite. We've observed many kisses, but very few miracles. Nevertheless, many managerial princesses remain serenely confident about the future potency of their kisses, even after their corporate backyards are knee-deep in unresponsive toads. 1981. Businesses: the great, the good, and the gruesome. Let's take a look at what kind of businesses turn us on. And while we're at it, let's also discuss what we wish to avoid. Charlie and I look for companies that have A, a business we understand, B, favorable long-term economics, C, able and trustworthy management, and D, a sensible price tag. We like to buy the whole business, or, if management is our partner, at least 80%. When controlled-type purchases of quality aren't available, though, we are also happy to simply buy small portions of great businesses by way of stock market purchases. It's better to have a part interest in the Hope Diamond than to own all of a rhinestone. A truly great business must have an enduring moat that protects excellent returns on invested capital. The dynamics of capitalism guarantee that competitors will repeatedly assault any business castle that is earning high returns. Therefore, a formidable barrier such as a company's being the low-cost producer, Geico, Costco, or possessing a powerful worldwide brand, Coca-Cola, Gillette, American Express, is essential for sustained success. Business history is filled with Roman candles, companies whose moats proved illusory and were soon crossed. Our criterion of enduring causes us to rule out companies in industries prone to rapid and continuous change. Though capitalism's creative destruction is highly beneficial for society, it precludes investment certainty. A moat that must be continuously rebuilt will eventually be no moat at all. Additionally, this criterion eliminates the business whose success depends on having a great manager. Of course, a terrific CEO is a huge asset for any enterprise, and at Berkshire we have an abundance of these managers. Their abilities have created billions of dollars of value that would never have materialized if typical CEOs had been running their businesses. But if a business requires a superstar to produce great results, the business itself cannot be deemed great. A medical partnership led by your area's premier brain surgeon may enjoy outsized and growing earnings, but that tells little about its future. The partnership's moat will go when the surgeon goes. You can count, though, on the moat of the Mayo Clinic to endure, even though you can't name its CEO. Long-term competitive advantage in a stable industry is what we seek in a business. If that comes with rapid organic growth, great. But even without organic growth, such a business is rewarding. We will simply take the lush earnings of the business and use them to buy similar business elsewhere. There's no rule that you have to invest money where you've earned it. Indeed, it's often a mistake to do so. Truly great businesses, earning huge returns on tangible assets, can for any extended period reinvest a large portion of their earnings internally at high rates of return. Let's look at the prototype of a dream business, our own See's Candy. The boxed chocolates industry in which it operates is unexciting. Per capita consumption in the U.S. is extremely low and doesn't grow. Many once important brands have disappeared, and only 3 companies have earned more than token profits over the last 40 years. Indeed, I believe that See's, though it obtains the bulk of its revenues from only a few states, accounts for nearly half of the entire industry's earnings. At See's, annual sales were 16 million pounds of candy when Blue Chip Stamps purchased the company in 1972. Charlie and I controlled Blue Chip at the time and later merged it into Berkshire. Last year, See's sold 31 million pounds, a growth rate of only 2% annually. Yet its durable competitive advantage, built by the See's family over a 50-year period, and strengthened subsequently by Chuck Huggins and Brad Kinstler, has produced extraordinary results for Berkshire. We bought See's for $25 million when its sales were $30 million and pre-tax earnings were less than $5 million. The capital then required to conduct the business was $8 million. Modest seasonal debt was also needed for a few months each year. Consequently, the company was earning 60% pre-tax on invested capital. 2 factors helped to minimize the funds required for operations. First, the product was sold for cash, and that eliminated accounts receivable. Second, the production and distribution cycle was short, which minimized inventories. Last year, See's sales were $383 million, and pre-tax profits were $82 million. The capital now required to run the business is $40 million. This means we have had to reinvest only $32 million since 1972 to handle the modest physical growth and somewhat immodest financial growth of the business. In the meantime, pre-tax earnings have totaled $1.35 billion. All of that, except for the $32 million, has been sent to Berkshire, or in the early years, to Blue Chip. After paying corporate taxes on the profits, we have used the rest to buy other attractive businesses. Just as Adam and Eve kick-started an activity that led to 6 billion humans, See's has given birth to multiple new streams of cash for us. The biblical command to be fruitful and multiply is one we take seriously at Berkshire. There aren't many See's in corporate America. Typically, companies that increase their earnings from $5 million to $82 million require, say, $400 million or so of capital investment to finance their growth. That's because growing businesses have both working capital needs that increase in proportion to sales growth and significant requirements for fixed asset investments. A company that needs large increases in capital to engender its growth may well prove to be a satisfactory investment. There is, to follow through on our example, nothing shabby about earning $82 million pre-tax on $400 million of net tangible assets. But that equation for the owner is vastly different from the C's situation. It's far better to have an ever-increasing stream of earnings with virtually no major capital requirements. Ask Microsoft or Google. One example of good, but far from sensational, business economics is our own flight safety. This company delivers benefits to its customers that are the equal of those delivered by any business that I know of. It also possesses a durable competitive advantage. Going to any other flight training provider than the best is like taking the low bid on a surgical procedure. Nevertheless, this business requires a significant reinvestment of earnings if it is to grow. When we purchased Flight Safety in 1996, its pre-tax operating earnings were $111 million, and its net investment in fixed assets was $570 million. Since our purchase, depreciation charges have totaled $923 million. But capital expenditures have totaled $1.635 billion, most of that for simulators to match the new airplane models that are constantly being introduced. A simulator can cost us more than $12 million, and we have 273 of them. Our fixed assets, after depreciation, now amount to $1.079 billion. Pre-tax operating earnings in 2007 were $270 million, a gain of $159 million since 1996. That gain gave us a good, but far from C's-like, return on our incremental investment of $509 million. Consequently, if measured only by economic returns, flight safety is an excellent but not extraordinary business. It's put up more to earn more experience is that faced by most corporations. For example, our large investment in regulated utilities falls squarely in this category. We will earn considerably more money in this business 10 years from now, but we will invest many billions to make it. Now let's move to the gruesome. The worst sort of business is one that grows rapidly, requires significant capital to engender the growth, and then earns little or no money. Think airlines. Here, a durable competitive advantage has proven elusive ever since the days of the Wright brothers. Indeed, if a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a huge favor by shooting Orville down. The airline industry's demand for capital ever since that first flight has been insatiable. Investors have poured money into a bottomless pit, attracted by growth when they should have been repelled by it. And I, to my shame, participated in this foolishness when I had Berkshire buy U.S. Air preferred stock in 1989. As the ink was drying on our check, the company went into a tailspin, and before long our preferred dividend was no longer being paid. But we then got very lucky. In one of the recurrent, but always misguided, bursts of optimism for airlines, we were actually able to sell our shares in 1998 for a hefty gain. In the decade following our sale, the company went bankrupt twice. 2007. Even Homer nods, or why good businesses are better than poor ones. Mistakes of the first 25 years, a condensed version. To quote Robert Benchley, having a dog teaches a boy fidelity, perseverance, and to turn around 3 times before lying down. Such are the shortcomings of experience. Nevertheless, it's a good idea to review past mistakes before committing new ones. So let's take a quick look at the last 25 years. My first mistake, of course, was in buying control of Berkshire. Though I knew its business, textile manufacturing to be unpromising, I was enticed to buy because the price looked cheap. Stock purchases of that kind had proved reasonably rewarding in my early years, though by the time Berkshire came along in 1965, I was becoming aware that the strategy was not ideal. If you buy a stock at a sufficiently low price, there will usually be some hiccup in the fortunes of the business that gives you a chance to unload at a decent profit, even though the long-term performance of the business may be terrible. I call this the cigar butt approach to investing. A cigar butt found on the street that has only one puff left in it may not offer much of a smoke, but the bargain purchase will make that puff all profit. Unless you are a liquidator, that kind of approach to buying businesses is foolish. First, the original bargain price probably will not turn out to be such a steal after all. In a difficult business, no sooner is one problem solved than another surfaces. Never is there just one cockroach in the kitchen. Second, any initial advantage you secure will be quickly eroded by the low return that the business earns. For example, if you buy a business for $8 million that can be sold or liquidated for $10 million and promptly take either course, you can realize a high return. But the investment will disappoint if the business is sold for $10 million in 10 years, and in the interim has annually earned and distributed only a few % on cost. Time is the friend of the wonderful business, the enemy of the mediocre. You might think this principle is obvious, but I had to learn it the hard way. In fact, I had to learn it several times over. Shortly before purchasing Berkshire, I acquired a Baltimore department store, Hochschild Kohn, buying through a company called Diversified Retailing that later merged with Berkshire. I bought at a substantial discount from book value, the people were first class, and the deal included some extras, unrecorded real estate values, and a significant LIFO inventory cushion. How could I miss? 3 years later, I was lucky to sell the business for about what I had paid. After ending our corporate marriage to Hochschild Kohn, I had memories like those of the husband in the country song, "My wife ran away with my best friend, and I still miss him a lot." I could give you other personal examples of bargain purchase folly, but I'm sure you get the picture. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Charlie understood this early. I was a slow learner. But now, when buying companies or common stocks, we look for first-class businesses accompanied by first-class managements. That leads right into a related lesson. Good jockeys will do well on good horses, but not on broken-down nags. Both Berkshire's textile business and Hochschild Kohn had able and honest people running them. The same managers employed in a business with good economic characteristics would have achieved fine records. But they were never going to make any progress while running in quicksand. I've said many times that when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. I just wish I hadn't been so energetic in creating examples. My behavior has matched that admitted by Mae West. I was Snow White, but I drifted. A further related lesson: easy does it. After 25 years of buying and supervising a great variety of businesses, Charlie and I have not learned how to solve difficult business problems. What we have learned is to avoid them. To the extent we have been successful, it is because we concentrated on identifying one-foot hurdles that we could step over rather than because we acquired any ability to clear 7-footers. My most surprising discovery: the overwhelming importance in business of an unseen force that we might call the institutional imperative. In business school, I was given no hint of the imperative's existence, and I did not intuitively understand it when I entered the business world. I thought then that decent, intelligent, and experienced managers would automatically make rational business decisions. But I learned over time that isn't so. Instead, rationality frequently wilts when the institutional imperative comes into play. For example, 1. As if governed by Newton's first law of motion, an institution will resist any change in its current direction. 2. Just as work expands to fill available time, corporate projects or acquisitions will materialize to soak up available funds. 3. Any business craving of the leader, however foolish, will be quickly supported by detailed rate of return and strategic studies prepared by his troops. And 4. The behavior of peer companies, whether they are expanding, acquiring, setting executive compensation, or whatever, will be mindlessly imitated. Institutional dynamics, not venality or stupidity, set businesses on these courses, which are too often misguided. After making some expensive mistakes because I ignored the power of the imperative, I have tried to organize and manage Berkshire in ways that minimize its influence. Furthermore, Charlie and I have attempted to concentrate our investments in companies that appear alert to the problem. Our consistently conservative financial policies may appear to have been a mistake, but in my view, were not. In retrospect, it is clear that significantly higher, though still conventional, leverage ratios at Berkshire would have produced considerably better returns on equity than the 23.8% we have actually averaged. Even in 1965, perhaps we could have judged there to be a 99% probability that higher leverage would lead to nothing but good. Correspondingly, we might have seen only a 1% chance that some shock factor, external or internal, would cause a conventional debt ratio to produce a result falling somewhere between temporary anguish and default. We wouldn't have liked those 99-to-1 odds, and never will. A small chance of distress or disgrace cannot, in our view, be offset by a large chance of extra returns. If your actions are sensible, you are certain to get good results. In most such cases, leverage just moves things along faster. Charlie and I have never been in a big hurry. We enjoy the process far more than the proceeds, though we have learned to live with those also. 1989. A final word on good businesses and good management. My conclusion from my own experiences, and from much observation of other businesses, is that a good managerial record, measured by economic returns, is far more a function of what business boat you get into than it is of how effectively you row, though intelligence and effort help considerably, of course, in any business, good or bad. Some years ago I wrote, "When a management with a reputation for brilliance tackles a business with a reputation for poor fundamental economics, it is the reputation of the business that remains intact." Nothing has since changed my point of view on the matter. Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. 1985. Concluding thoughts on investing. Investing is often described as the process of laying out money now in the expectation of receiving more money in the future. At Berkshire, we take a more demanding approach, defining investing as the transfer to others of purchasing power now with the reasoned expectation of receiving more purchasing power after taxes have been paid on nominal gains in the future. More succinctly, investing is foregoing consumption now in order to have the ability to consume more at a later date. From our definition, there flows an important corollary. The riskiness of an investment is not measured by beta, a Wall Street term encompassing volatility and often used in measuring risk, but rather by the probability, the reasoned probability, of that investment causing its owner a loss of purchasing power over his contemplated holding period. Assets can fluctuate greatly in price and not be risky as long as they are reasonably certain to deliver increased purchasing power over their holding period. And as we will hear, a non-fluctuating asset can be laden with risk. Investment possibilities are both many and varied. There are 3 major categories, however, and it's important to understand the characteristics of each. So let's survey the field. Investments that are denominated in a given currency include money market funds, bonds, mortgages, bank deposits, and other instruments. Many of these currency-based investments are thought of as safe. In truth, they are among the most dangerous of assets. Their beta may be zero, but their risk is huge. Over the past century, these instruments have destroyed the purchasing power of investors in many countries, even as the holders continued to receive timely payments of interest and principal. This ugly result, moreover, will forever recur. Governments determine the ultimate value of money, and systemic forces will sometimes cause them to gravitate to policies that produce inflation. From time to time, such policies spin out of control. Even in the U.S., where the wish for a stable currency is strong, the dollar has fallen a staggering 86% in value since 1965, when I took over management of Berkshire. It takes no less than $7 today to buy what $1 did at that time. Consequently, a tax-free institution would have needed 4.3% interest annually from bond investments over that period to simply maintain its purchasing power. Its managers would have been kidding themselves if they thought of any portion of that interest as income. Beyond the requirements that liquidity and regulators impose on us, we will purchase currency-related securities only if they offer the possibility of unusual gain, either because a particular credit is mispriced, as can occur in periodic junk bond debacles, or because rates rise to a level that offers the possibility of realizing substantial capital gains on high-grade bonds when rates fall. Though we've exploited both opportunities in the past, and may do so again, we are now 180 degrees removed from such prospects. Today, a wry comment that Wall Streeter Shelby Cullum Davis made long ago seems apt. Bonds promoted as offering risk-free returns are now priced to deliver return-free risk. The second major category of investments involves assets that will never produce anything, but that are purchased in the buyer's hope that someone else, who also knows that the assets will be forever unproductive, will pay more for them in the future. Tulips, of all things, briefly became a favorite of such buyers in the 17th century. This type of investment requires an expanding pool of buyers, who in turn are enticed because they believe the buying pool will expand still further. Owners are not inspired by what the asset itself can produce, it will remain lifeless forever, but rather by the belief that others will desire it even more avidly in the future. The major asset in this category is gold, currently a huge favorite of investors who fear almost all other assets, especially paper money, of whose value, as noted, they are right to be fearful. Today, the world's gold stock is about 170,000 metric tons. If all of this gold were melded together, it would form a cube of about 68 feet per side. Picture it fitting comfortably within a baseball infield. At $1,750 per ounce, gold's price, as I write this, its value would be $9.6 trillion. Call this cube Pile A. Let's now create a Pile B, costing an equal amount. For that, we could buy all U.S. cropland, 400 million acres with output of about $200 billion annually, plus 16 ExxonMobils, the world's most profitable company, one earning more than $40 billion annually. After these purchases, we would have about $1 trillion left over for walking around money. No sense feeling strapped after this buying binge. Can you imagine an investor with $9.6 trillion selecting Pile A over Pile B? A century from now, the 400 million acres of farmland will have produced staggering amounts of corn, wheat, cotton, and other crops, and will continue to produce that valuable bounty, whatever the currency may be. ExxonMobil will probably have delivered trillions of dollars in dividends to its owners, and will also hold assets worth many more trillions. And remember, you get 16 Exxons. The 170,000 tons of gold will be unchanged in size and still incapable of producing anything. You can fondle the cube, but it will not respond. Our first two categories enjoy maximum popularity at peaks of fear. Terror over economic collapse drives individuals to currency-based assets, most particularly U.S. obligations, and fear of currency collapse fosters movement to sterile assets such as gold. We heard cash is king in late 2008, just when cash should have been deployed rather than held. Similarly, we heard cash is trash in the early 1980s, just when fixed dollar investments were at their most attractive level in memory. On those occasions, investors who required a supportive crowd paid dearly for that comfort. My own preference, and you knew this was coming, is our third category: investment in productive assets, whether businesses, farms, or real estate. Ideally, these assets should have the ability in inflationary times to deliver output that will retain its purchasing power value while requiring a minimum of new capital investment. Farms, real estate, and many businesses such as Coca-Cola, IBM, and our own See's Candy meet that double-barreled test. Certain other companies, think of our regulated utilities for example, fail it because inflation places heavy capital requirements on them. To earn more, their owners must invest more. Even so, these investments will remain superior to non-productive or currency-based assets. 2011. Bonds as businesses. Washington Public Power Supply System. From October 1983 through June 1984, Berkshire's insurance subsidiaries continuously purchased large quantities of bonds of Projects 1, 2, and 3 of Washington Public Power Supply System, WPPSS. This is the same entity that on July 1, 1983, defaulted on $2.2 billion of bonds issued to finance partial construction of the now abandoned Projects 4 and 5. While there are material differences in the obligors, promises, and properties underlying the two categories of bonds, the problems of Projects 4 and 5 have cast a major cloud over Projects 1, 2, and 3, and might possibly cause serious problems for the latter issues. In addition, there have been a multitude of problems related directly to Projects 1, 2, and 3 that could weaken or destroy an otherwise strong credit position arising from guarantees by Bonneville Power Administration. Despite these important negatives, Charlie and I judged the risks at the time we purchased the bonds, and at the prices Berkshire paid,